fiscal year 24, India's GDP came in at an impressive 8.2%. Now, this figure was higher than the most optimistic projections. Now, before we jump into the recently released Q1 fiscal year 25 data, let us address three areas that raise some concerns about fiscal year 24 data. Now, first, the agriculture sector showed muted growth. Now, why is this important? Agriculture is a significant part of our economy, and when it does not perform well, it impacts rural incomes and overall economic stability. Now, the second concern was the moderate growth in private consumption expenditure. Now, this is crucial because private consumption is like the engine that drives India's growth story. When people aren't spending as much, it can slow down the whole economy. And third, we noticed subdued private investment, which is often measured by something called gross fixed capital formation. Now, this basically refers to investments in assets like machinery, buildings, and infrastructure. Now, when this slows down, it suggests businesses are not as confident about the future, which can be a red flag for long-term growth. Now, to understand this better, let's look at how GDP is calculated. Now, one common method is the expenditure approach, which breaks down GDP into four main components. Now, private consumption is the money we spend as individual on things like cars, food, clothing, education, healthcare, and so on. Now, this accounts for about 56.3% of our GDP, making it the largest component. Now, investments denoted by gross fixed capital formation represents about 35% of our GDP and includes spending by businesses, governments, households on things like machinery, infrastructure, and buildings. Government consumption expenditure is what the government spends on goods and services to maintain public services and operations, accounting for around 9.5% of GDP. Now, net exports, it's the difference between what we export and what we import. Now, for India, because we import more than we export, this often negatively impacts our GDP. Now, if we combine all of these components, we get the total GDP. Now, think of it as adding up all the money spent on consumption, investments, government activities, and the balance of imports and exports in a year. So, coming to the first quarter of fiscal year 25 data, which was April to June 2024, we saw the Indian economy grow at a 5-quarter low of 6.7%. Now, this was slightly lower than what the central bank had expected, which was 7.1%. On the bright side, private consumption picked up pace, growing at 7.4% after being sluggish for several quarters. Now, gross fixed capital formation also saw a pickup, while government spending was down. In the industrial sector, all four components saw an acceleration, with electricity and construction growing at their highest pace in 3 quarters. The service sector also saw decent growth, but on the downside, growth in the farm sector remained muted. So why did we see a fall in the GDP? It's mostly due to subdued government spending and slow growth in the agriculture sector. In response to the slowdown, Goldman Sachs has trimmed India's growth forecast for the current year to 6.7%, and Bloomberg Economics lowered its projection to 6.8% from 7.2%. Now, despite these challenges, there is a silver lining. The increase in private consumption and a modest improvement in investment activity suggest that the private investment cycle might be picking up. Now, a normal monsoon would also help boost overall consumption, ease inflation, and support farm income. Moreover, if we see an increase in government capital expenditure in the coming quarters, it could also give a further boost to overall growth. So while there are some concerns, the underlying data points to a positive outlook for India's economy. Having said that, this is me, Merlin, signing off. Take care and stay invested.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.